Welcome back to Investing Talk Podcast. Today we are really zeroing in on one of the most volatile sectors out there, pre-revenue biotech. Specifically, we've gathered the sources on Processa Pharmaceuticals, that's PCSA, and we're tackling the big question. Is now actually a good time to buy?
Yeah, it's a fascinating one because Processa is, almost a textbook case of binary risk. You've got this huge financial risk profile, which is pretty typical for a company running purely on hope and future potential. But then the sources also show some clear clinical timelines coming up, a pretty significant strategic shift recently, and honestly, some surprisingly strong technical momentum in the stock price.
Yeah.
So our goal today is really to cut through those conflicting signals. We want to pull out the critical points for you so you can properly weigh that risk-reward balance.
Absolutely. And look, if you find this kind of focused analysis valuable, please do us a quick favor, subscribe, like this discussion, and drop a comment below. Seriously, if there's a specific company you want us to look into down the road, just put the ticker symbol in the comments. We'll add it to our research list. Okay, let's dive in. Starting with the hard numbers, the financial reality. Processa Pharmaceuticals, it's a clinical stage biopharma. What does that actually mean day to day?
It means fundamentally all their work is pre-commercial. They aren't selling anything yet. And that translates directly onto the balance sheet as, well, a pretty serious cash burn. They reported absolutely zero revenue in the last quarter. None.
Zero revenue. Okay.
Yeah. And without that income, every financial number becomes about how fast they're spending money. The Q2 2025 net loss came in at 0.25 cents per share. That was actually a bit worse than the $1.23 loss analysts were expecting.
That widening loss. That feels like a bit of a red flag, doesn't it?
Yeah.
It's just the burn rate might even be picking up speed faster than modeled.
It's definitely a critical signal to watch, yeah. The trailing 12 months net loss is already knocking on the door of $13 million. Look, this is a company fueled entirely by investor belief and, crucially, by fresh capital injections.
And the forecasts don't look much better near term.
No, the consensus projection for the full year 2025 is for that net loss to widen even more, to around $0.43 per share. That's just the reality, the steep cost of running these high-stakes oncology trials.
Okay, so the burn is real. But despite that pressure, their financial structure has a couple of interesting points. We're talking a pretty small market cap, right? Somewhere between $18 and $24 million.
Yeah, very small cap. And a key point you noted, no disclosed debt.
Right, no debt.
That lack of leverage structurally is a positive. It means they aren't burdened by interest payments on top of everything else. But like you said, it also confirms they fund operations almost entirely through selling shares through equity.
Which brings us right back to the big near-term worry. Liquidity. Cash. Free cash flow must be negative, just pouring into R&D.
Oh, absolutely negative XCF. All consumed by research and development. And naturally, forget about dividends or stock buybacks. That's not happening.
So the crucial question then, how are they keeping the lights on? How do they fund these expensive trials?
Well, they did address that directly quite recently, actually. Back in July 2025, the company raised $7 million in fresh capital.
Okay, $7 million. That helps.
It definitely bolsters the cash position, but, and this is vital for anyone watching this stock, the crucial date is coming up fast, October 29th. That's when they report their Q3 2025 earnings.
And that's going to reveal.
It'll show the updated cash balance and, critically, their projected near-term runway. How long can that $7 million plus whatever they had last them? If that runway looks short, they have to raise more money, and that usually means
dilution, issuing more shares, which hits the value of existing shares.
Exactly, dilutive funding. So that October 29th report, it's a massive inflection point, truly a must-watch.
Okay, so cash burning fast, runway is the key question for October 29th. If the balance sheet is that tight, what's the potential home run? What's the science they're swinging for that justifies all this expense? Let's unpack that value proposition.
Right. The entire investment case really hinges on their pipeline focus. They're developing what they call next-generation chemotherapies, specifically a drug candidate called NGC-Cap.
NGC-Cap, that stands for Next Generation Capecitabine.
Correct, next-gen capecitabine. And it's targeting metastatic breast cancer. They kicked off a phase 2 trial for that back in October 2024.
Now, what's really interesting to me here is their strategy, their approach. They're not trying to invent something completely brand new from scratch, are they?
Yeah.
Which can take, forever and cost a fortune.
Exactly. Their approach is actually quite clever, arguably less risky than traditional drug discovery. They take existing, already FDA-approved drugs in this case, capecitabine, a known chemo agent, and they modify it.
Modify to how? To what end?
The goal is to improve safety, boost efficacy, maybe reduce some of those awful side effects, but while keeping the core cancer-fighting mechanism intact. Because they're working with a known quantity in existing drug, it potentially offers a faster path through regulatory hurdles.
And ideally, better outcomes for patients compared to the current standard chemo.
That's the hope. Better safety, better efficacy, it's smart, it's incremental innovation, but if it works, it could unlock tremendous value.
And the potential market for an improved breast cancer therapy, it's huge, right?
Oh, it's substantial. Globally, you're looking at over 2 million new breast cancer cases every single year. So success in the metastatic setting, that addresses a massive unmet medical need. There's a built-in commercial runway there for decades if they get it right.
And they really doubled down on this oncology focus recently, didn't they? There was that big strategic pivot back in July.
Yes, that move was very telling. It signaled total management focus. They granted another company, Intact Therapeutics, an exclusive option to license a different non-core asset called PCS12852.
An option? Yeah. So not sold outright, but potential future value.
Exactly. That deal could yield up to $454 million in milestones down the road, plus a 12% royalty. Huge potential value there. But by effectively parking that non-core asset, Processa basically shouted to the market, our future is NGC cap.
All chips on oncology.
All chips, all capital, all executive attention, focused on pushing that core oncology pipeline towards that critical data readout. It's bold, high stakes, but clear focus.
Okay, that really sets the fundamental stage. High risk, high reward science, tight cash. Now let's shift gears to the trading floor. Because despite those, frankly, kind of scary financials and the obvious clinical risks, the stock chart, well, it's telling a very different story lately, a very aggressive one.
It really is. I mean, this stock has been a roller coaster, no doubt. The 52-week range tells you everything. A low of 15 cents, a high of $1.50.
Wow.
But what's really standing out now is the recent technical strength. It's up something like 50% in just the last 6 months.
That kind of momentum is hard to ignore. What are the key technical signals saying? We don't need every number, just the gist. What's the chart telling us?
The chart is basically screaming bullish trend. Technical analysis shows support seems to be holding pretty well, sort of in that $0.36 range. Resistance is still there, up between, say, $2.57 and $1. But crucially, all the key moving averages, the short-term ones, like the 10-day, 20-day, even the 50-day, they're all below the current price.
Which confirms the upward trend is pretty solid for now.
It confirms a prevailing, sustained bullish trend, yes. And the oscillators, things like RSI and MACD, they generally back that up. I think something like 12 out of 17 indicators we track are flashing by.
Okay, strong technicals. But I have to ask, you've got this tiny company, super volatile, very low float probably, and then you have one analyst covering it, slapping a strong buy on it with a $1 price target that's like over 100% upside from recent levels. Is this genuine fundamental belief driving the chart, or is it maybe more about that retail investor excitement and social media buzz you hinted at?
That's the million-dollar question, isn't it? And the answer is probably both. It looks like a symbiotic relationship. The analyst target gives it a veneer of, let's say, institutional validation, a reason to believe. But the day-to-day price action, oh yeah, that seems heavily influenced by retail volume and sentiment. We saw the stock spike, what was it, 37.5% after hours just recently.
Yeah, I saw that pop.
And it correlated directly with chatter picking up on social media about upcoming milestones. That kind of retail engagement can create these huge volume surges, push the price up fast, but it also ramps up the volatility risk dramatically. It can swing both ways very quickly.
So it sounds like the entire investment thesis, both fundamental and technical, really boils down to hitting specific dates on the calendar, events that will either prove the science works or will potentially crater the stock. What are those key short-term catalysts we need to have circled, say, next 90 days?
Okay, most immediate. October 29th, 2025, that's Q3 earnings. That's D-Day for the cash burn update and the runway calculation. The market will judge management right there, and it directly impacts that dilution risk we talked about.
Right, the big cash reveal. Anything else before year-end?
Well, less direct impact, but you have institutional deadlines. The holdings disclosure deadline is early December, potential ETF rebalancing in mid-November. Those could influence buying or selling pressure, but they're secondary to the company news.
Got it. But the real make or break event, the one that defines binary catalyst that comes just after the new year, right? That's the whole ballgame.
That is absolutely it. The key long-term catalyst, though it's not that far off now, is the initial data readout from that NGC CAP Phase 2 trial. The target date we have for that is January 15th, 2026.
January 15th.
And yes, that's the definition of a binary catalyst. The result is essentially pass-fail for the market's perception right now. If that interim data looks good, meets the safety and efficacy goals, that is the event that could lead to institutional re-rating, sustained price appreciation. If it fails, the stock will likely collapse, probably towards whatever cash value it has left. It's that stark.
And if the data is good, success often breeds speculation, right?
Yeah.
What's the unconfirmed chatter or rumor mill saying could happen after positive data?
Well, the market's already whispering about a couple of things. First, immediate talks about strategic partnerships. Could be licensing deals, maybe even outright M&A interest from bigger oncology players wanting a promising Phase 2 asset.
Which would lock in value pretty quickly for shareholders.
We would crystallize value rapidly, yes. But there's also the other side of the coin. Given the stock price has been bumping along at low levels, under pressure maybe for Nasdaq listing compliance, there are also persistent rumors about a potential reverse stock split. The dreaded reverse split. Consolidates shares to boost the price, but often seen negatively by the market.
Often, yes. It doesn't change the company's value, but the perception can be negative. So that's out there too.
Okay, let's try and wrap the risks together then. If someone's listening and considering this, they need to be eyes wide open about the dual risks here.
Absolutely crystal clear on the risks. First, company-specific risk. It's almost entirely binary outcome risk, tied completely to those January 2026 clinical trial results for NGC CAP. Second, the immediate financial risk. High potential for dilutive funding depending entirely on that October 29th Q3 cash report. If the runway is short, expect new shares to be issued, period.
And just the general sector risk too, I suppose.
You have to accept that too, yes. Biotech stocks are just notoriously volatile. They can whipsaw violently on any news, good or bad, sometimes even on no news. High beta sector.
Okay. So boiling it all down, synthesizing the conclusion for listeners. Look, the short-term setup, meaning right now through maybe year-end, it is pretty attractive if you're an event-driven trader. You've got those bullish technicals, you've got defined catalysts like the earnings on October 29th. The long-term upside, if NGC CAP works, it's compelling. You could rate it highly bullish, maybe an 8 out of 10 on potential. And it's a huge, but you absolutely must have a high tolerance for risk. The future value here hinges totally on that Phase 2 data readout in January 2026 being positive.
That gives a really clear picture of the clinical path and the financial tightrope they're walking. Before we wrap up, let me leave you with one final, maybe provocative thought to chew on. We know Processa urgently needs continued access to capital. Their whole future depends on successful data to keep the market interested. Now, we also know, according to the sources, that the company recently had to adjourn and then reschedule a special shareholder meeting back in September. Why? To deal with some unresolved governance proposals.
I saw that mentioned.
So the question is, given how much they rely on outside funding and market confidence, how should investors weigh these governance issues? Does the potential clinical home run just totally overshadow any shareholder or operational concerns? Or do these kinds of governance hiccups introduce another layer of risk? Could it potentially scare off institutional partners or M&A suitors, even if the clinical data turns out to be good?
That's a really sharp point. Operational stability and clean governance. They're often overlooked in these high science stories, but they matter, especially for potential partners or acquirers. Anything suggesting internal distraction or unresolved issues definitely adds a layer of, let's call it, qualitative risk. It's certainly a factor worth keeping an eye on alongside the clinical news.
Indeed. Something to consider. Well, thank you for tuning in to this analysis of Processa Pharmaceuticals. We appreciate your time. We'll catch you on the next Investing Talk podcast.